Right now, there is a policy change sitting inside your banking system with your account number attached to it. This isn't a rumor, and it isn't a maybe. It's an actual policy already in effect that is changing what your checking account costs, how your transactions are watched, and who your bank can call about your money. Most seniors over 60 will never hear about a single one of these three rules. That isn't because they were denied information, but because nobody ever sat them down and explained it in language they could actually act on. I'm about to do exactly that in plain English, starting right now. My name is Lana Mains. I break down financial information to help you protect the money you've already earned and keep more of what belongs to you. If that's useful to you, hit subscribe, because this is exactly the kind of thing I cover every single week, one rule, one form, and one fee at a time. Let's get right into it. If you have a checking account and you are over 60, 3 new rules have quietly gone into effect at banks across the country, and most seniors don't know a thing about them. It's not that these rules are hidden exactly, they're in the paperwork, the disclosures, and those terms and conditions updates your bank mailed you in an envelope that looked like junk mail. But here is what happens to real people every day. The rules go into effect, accounts change, fees pop up, holds get placed, and the seniors affected have no idea it was coming because nobody at the local branch walked them through it. There are 3 rules in total. One of them sounds protective and mostly is, with one major catch that can freeze access to your own money without warning. Another is running silently right now inside your bank's software, shaping how your transactions are reviewed, flagged, and potentially held. And the third rule, the one most banks are quietly hoping you never ask about, directly changes what your checking account costs and under what conditions you get to keep it. Stay with me through all 3. The last one isn't the most complicated, but it is the most expensive, and the fix is very specific. I represent taxpayers and work with retirees, and people approaching retirement who are navigating the part of financial life nobody prepares you for. Not the accumulating, but the protecting. It's that moment when your money stops growing and starts being the only thing standing between you and everything you've worked for. The people I sit across from aren't wealthy in a way that shields them from rules like these. They are careful, responsible people who have done everything right, yet they are still getting caught off guard by banking changes they were never told about. I want to address 2 specific groups watching this right now, and I'll speak to both throughout this video so everyone knows how this applies to them. If you are on a fixed income Social Security, a modest pension, or limited savings, these rules hit you most immediately because fee changes and account restructuring hurt worst when there's no financial cushion. If you are a comfortable retiree with more assets and flexibility, these rules still reach you because the monitoring protocols and trusted contact changes apply to every account regardless of your balance. One group needs this information to avoid unexpected costs they can't absorb, while the other needs it to prevent delays and interference on transactions they have every right to make. Neither group is exempt. Let's talk about what triggered all of this, because if you don't understand the cause, these rules will feel completely random. They aren't. Elder financial exploitation is now the fastest growing category of financial crime in the United States. The Consumer Financial Protection Bureau has documented billions of dollars in annual losses to seniors from fraud, scams, and what regulators call undue influence, situations where a family member, caregiver, or outside party pressures an older account holder into transactions that benefit someone else. Because of this, the Federal Deposit Insurance Corporation has updated its guidance to financial institutions multiple times over the past several years, specifically regarding older customers. That guidance isn't legally binding like a statute, but banks follow it anyway, because the alternative is an intense compliance examination nobody wants to go through. The result has been a massive wave of internal policy changes at banks large and small. Most were never announced with a flashy press release. They arrived buried in updated account agreements, revised terms of service, and the quiet retraining of branch staff. But they are very real, they are active, and they apply to you right now if you're over 60 with a checking account almost anywhere in the country. Some of these changes are genuinely protective. There are real scenarios where a new rule catches something that saves a family tens of thousands of dollars. However, when protective rules are applied broadly to everyone, regardless of their actual situation, they create massive friction. For a retired woman who has competently managed her own finances for 40 years and is simply trying to move her own money, that friction isn't protection, it's an obstacle. It costs time, dignity, and sometimes real money. That tension between protection and access sits right at the center of all three rules. And the people who lose the most are the ones who never knew the rules existed in the first place. The banks aren't necessarily the villains here. The incentive structure is the problem. An institution that implements strict protective protocols for older customers faces less regulatory scrutiny, while an institution that fails to catch elder exploitation faces heavy fines, litigation, and severe reputational damage. So the protocols get rolled out broadly, and seniors who never needed them get swept in along with everyone else. That's the system. Now let's look at what this actually does to your account. The first rule sounds protective, but as I mentioned, it comes with a catch that can freeze your access. That's where we'll start. Rule number 1 is the trusted contact requirement. The trusted contact policy is the most visible of the three changes because many banks are now actively asking customers to designate one, whether at the branch, online, or during routine account updates. A trusted contact is a person you name, a family member, close friend, or attorney whom the bank is authorized to reach out to if they have a concern about your account. That's the nice version the bank will describe to you. What they won't explain in equal detail is how it actually plays out. Under the framework issued by the Financial Industry Regulatory Authority, FINRA Rule 4512, financial institutions are encouraged to make reasonable efforts to collect trusted contact information from customers. For brokerage accounts, this is a formal requirement. For checking accounts at commercial banks, it remains guidance, but most major institutions have adopted the practice anyway. The bank can reach out to your trusted contact if they suspect you may have diminished capacity, if they suspect financial exploitation, or if they've been unable to contact you regarding unusual activity on your account. Here is the catch that trips people up. A trusted contact cannot access your account, make transactions, or override your decisions. However, they can be informed that the bank has a concern, and that conversation can happen entirely without your direct knowledge in the moment. The bank doesn't have to call you first to ask for permission. That call goes out based strictly on the institution's internal assessment of your transaction patterns. Take a woman named Margaret, for example. She's 72, a retired registered nurse from Tucson, and had managed her own finances for 43 years without a single incident. Last spring, she received a wire transfer of $28,000 from the sale of land her late husband owned in another state. The branch flagged the incoming wire as unusual based on her transaction history, and a compliance note went into the system. 2 days later, Margaret's daughter, who lives out of state, received a call from the bank expressing concern about unusual account activity. Panicked, she called her mother immediately. Margaret had done nothing wrong, the transaction was completely clean and fully documented, but the call had already gone out. Margaret then spent the next week managing her daughter's anxiety on top of her own estate paperwork. Applied mechanically, a routine transaction suddenly turned into a stressful family situation that never needed to happen. There is a real upside here for both groups, though. If you're a lower-income retiree, the trusted contact policy can actually work in your favor if you set it up on your own terms before the bank forces the issue under pressure. Choose someone who genuinely understands your finances and won't panic if the phone rings. If you're a comfortable retiree making larger transactions, like inheritance distributions, real estate proceeds, or transfers between accounts, knowing this rule exists means you can prepare documentation ahead of time instead of scrambling after the fact. The biggest mistake people make with this rule is naming someone as a trusted contact without ever telling them. A trusted contact who doesn't know they've been listed isn't a safeguard. They're a liability, because their immediate instinct will be to panic rather than confirm facts. Here is the step to take this week. Call or visit your bank and ask 2 direct questions. First, ask, Do you currently have a trusted contact on file for this account? Second, ask, if so, who is listed and when was it last updated? If nobody is on file, request the form and set the terms yourself. Don't let the bank pick the timing or the framing of that conversation for you. That covers the visible layer. Underneath it, running quietly on every single transaction you make, sits the second rule. Before we move on, open your actual checking account right now, not last month's paper statement, but your live balance and transaction history. Scan your last 10 transactions. Look at the amounts, the timing, and whether any involved cash, a wire, or an unusually large sum. What I'm about to explain is going to completely change how you read that list. Rule number 2 is transaction monitoring and the senior flag protocols. Banks have used automated transaction monitoring for decades, but what changed recently is the specificity of the triggers tied to age-correlated behavior. Internal compliance guidance updated across major institutions over the past 2 to 3 years added what banks call enhanced monitoring parameters for older account holders. None of this is public-facing. You won't find it listed on your bank's website. It lives in internal training materials and compliance frameworks that banks aren't required to disclose. In practice, this means that if you're over 60, your account may sit under a much lower threshold for human review than a younger account holder with an identical balance and history. A transaction that generates a passive automated note in a 35-year-old's account might trigger an actual hold or a branch callback in yours. And yes, this is legal. The Equal Credit Opportunity Act prohibits age discrimination in credit decisions, but it does not prohibit enhanced monitoring of account activity when applied as a protective measure. Specific behaviors trigger flags under these updated protocols: a withdrawal well above your historical average, a wire to an account that has never received one from you before, several cash withdrawals in a short window, a sudden shift in deposit patterns in either direction, activity at unusual hours or locations, or account access from a new device paired with an out-of-pattern transaction. While any single one of these might generate a flag, 2 or more occurring close together will almost certainly trigger a hold. Consider a man named Gerald, 67, a retired high school principal from Baton Rouge. His wife passed away 18 months ago, and over the following 6 months, he consolidated 3 accounts, his, hers, and their joint account of 22 years, into a single checking account. He moved the money across 4 separate transfers over 6 weeks, each under $15,000, simply because he could only handle so much paperwork at a time while grieving. The monitoring system flagged the pattern anyway, and a hold was placed on his account. Gerald had to show up in person with documentation before the money was released, waiting 11 days in total. He had done absolutely nothing wrong. Again, there is a genuine benefit to this, depending on your situation. If your spending is modest and consistent, you're less likely to trip these automated systems because your day-to-day activity matches the expected pattern. The real risk for you is a single, unusual event, like a large gift, an insurance payout, or an inheritance, since one out-of-pattern transaction stands out far more sharply against a small, steady balance than a large, varied one. If you're a comfortable retiree with more varied financial activity, the opposite is true. More variation gives the software more surface area to flag something. The most damaging mistake people make in response to this rule is trying to outsmart it by splitting large transactions into smaller pieces. That decision has a specific name under federal law: structuring. Under Title 31, United States Code, Section 5324, structuring is a federal felony. It does not matter if the money is completely legal or that you weren't trying to evade a criminal investigation. If you deliberately break up a deposit or withdrawal into smaller amounts to dodge a reporting threshold, that is a crime. The government can seize those funds through civil forfeiture without ever filing a criminal charge, leaving you to prove your innocence while your money sits completely frozen. Do not ever structure your money for any reason. Make the large transaction in one single piece with your documentation ready. A currency transaction report filed on a clean deposit is just routine paperwork. A structuring investigation is a massive, life-altering nightmare. The best move here is gathering documentation before you ever walk through the bank's door. If you're planning a transaction larger than your typical activity, anything over $5,000, if your average balance is small, or over $20,000 regardless, write a one-page summary of the source before you show up. Bring a bill of sale, a gift letter, a settlement letter, or a transfer confirmation, and hand it to the teller before they even ask. That simple step turns a potential investigation into a quick confirmation. So, here's what I want you to do. There are exemptions, breaks, and refunds that most seniors already qualify for but never actually claim. I've put them all in one place, state by state and form by form, so you don't have to waste hours digging through confusing government websites. Everything is laid out simply so any senior can quickly find what applies to them. No matter what state you live in, there is money you are likely leaving on the table. It's called the Senior Exemption Playbook, and you can find it in the first pinned comment right below this video. Just tap it once, and you'll have everything you need. Now, stay right here, because this final rule represents the single biggest expense most seniors never catch, and it's the main reason I made this entire video. Rule number 3 is the overdraft overhaul and the fee restructuring that followed it. In 2024, the Consumer Financial Protection Bureau finalized new rules under the Truth in Lending Act, governing overdraft fees at large financial institutions, specifically those with assets over $10 billion. The rule capped overdraft fees far below the $35 standard that major banks had charged for years. For a lower-income retiree who occasionally overdrew their account by a small amount, this was a massive win, turning a fee that used to be $35 per occurrence into a fraction of that cost. However, what happened next is the part almost nobody covered clearly. Banks do not simply absorb lost revenue, they relocate it. When the overdraft cap cut into their income stream, institutions restructured their account tiers to make up for the money elsewhere. That restructuring took several specific forms. New minimum balance requirements on accounts that previously had none, monthly maintenance fees on accounts once marketed as free for life or free for seniors, and much tighter criteria for fee waivers, meaning the required direct deposit amount or minimum daily balance went up significantly. In some cases, senior-specific checking accounts that had existed for decades were quietly discontinued or folded into standard accounts with strict new conditions attached. Take a woman named Dorothy, 74, a retired seamstress from Memphis. She had held the exact same senior checking account for 16 years with no monthly fee, no minimum balance requirement, and one free overdraft protection transfer per month. That account was her financial baseline. 18 months ago, her bank sent a letter stating that her senior account product was being consolidated into a new structure. The replacement account had no monthly fee if she maintained a $1,500 daily balance or received a $500 monthly direct deposit. Since her Social Security cleared that threshold easily, she assumed she was fine. Buried deep inside a 4-page disclosure, however, was a tiny detail. Overdraft protection transfers were now a fee-bearing service costing $12 per occurrence. She used that feature 3 times that year, paying $36 in fees she'd never had to pay in 16 years. She did nothing wrong, but the account she thought she had was no longer the account she actually owned. Once again, the impact splits depending on your situation. If you're on a fixed income at a large institution covered by the CFPB rule, the overdraft cap offers real protection against a $35 fee that could spiral into a cash flow crisis during a tough week. But minimum balance changes, and higher waiver thresholds may have simultaneously made your formerly free account much more expensive to maintain. The net effect depends entirely on your specific bank and account structure. If you're a comfortable retiree with a balance well above any minimum, this restructuring may not have hit you directly unless you had overdraft protection linked to a savings account as a convenience, in which case the terms of that convenience may have quietly shifted without clear notice. The mistake people make with this rule is assuming that because they've held the same account for years, the terms remain unchanged. They don't. Account agreements give banks the legal right to modify terms with notice, and that notice was sent. Most people simply didn't parse through the complex disclosure carefully enough to catch what actually changed. When fees start showing up on accounts that have been fee-free for a decade, people often chalk it up to a bank error rather than an intentional policy shift. Here is the step to take. Check your bank's website or call your local branch directly. Ask what your current monthly maintenance fee is and ask for the exact requirements needed every month to have it waived. Then ask what the current fee is for an overdraft protection transfer if you use that service. Write those numbers down and compare them to what you were paying a year or two ago. If something has changed, push back. Under FDIC guidance, banks are encouraged to offer accessible, low-cost account options for older customers. Many institutions still carry senior account products that simply aren't advertised anymore. You won't find them on the website. You have to ask for them specifically at the branch. Ask whether a senior checking account exists with no monthly fee and no minimum balance requirement, and ask what the exact eligibility criteria are. That conversation will only happen if you start it. There is a critical piece to all of this that rarely gets mentioned alongside these three rules, and it is worth understanding on its own: the difference between a trusted contact and a power of attorney. A trusted contact can only be notified of concerns. They have zero legal authority over your account. A power of attorney is a completely different legal instrument that gives a named individual actual authority to act on your accounts, sometimes immediately and sometimes only if you become incapacitated, depending on how the document is written. Banks are increasingly asking customers to clarify which one they have on file, because confusing the two has caused massive problems for families who assumed a trusted contact could step in to pay bills, only to find out at the teller counter that the person has no legal authority to do anything at all. If you don't currently have a durable power of attorney set up for your finances, that is a conversation worth having with an attorney, completely separate from anything your bank asks you to sign. It is also worth knowing where your money sits relative to FDIC insurance limits, especially if any recent account consolidations have moved your balances around. Standard FDIC coverage protects up to $250,000 per depositor per insured bank for each ownership category. A single checking account and a single savings account held the same way at the same bank share that $250,000 limit, they do not each get their own $250,000. If a major life event has led you to consolidate several accounts into one institution, or if an inheritance recently landed in your checking account, check whether your total balance at that bank now exceeds the insured limit. If it does, adjusting your ownership structure, such as adding a payable on death beneficiary, can restore full coverage. While this doesn't tie directly into the three rules, it's precisely the kind of oversight that happens during the exact same life moments that trigger transaction monitoring flags and trusted contact calls. There is a related safeguard that ties directly back into the transaction monitoring rule, and it's one most people never think to use until it's too late. Your dispute rights under Regulation E. If an unauthorized transaction hits your checking account, whether a scammer accessed your funds, a card was used without permission, or an unapproved transfer went out, federal law gives you the right to dispute it and get your money back, but only within specific timeframes. If you report an unauthorized transaction within 2 business days of discovering it, your maximum liability is capped at $50. If you wait longer, up to 60 days after your statement is sent, your liability can jump to $500. If you wait past that 60-day window, you could be responsible for the entire loss. This is exactly why reviewing your monthly statement matters so much, not just for catching hidden bank fees, but for catching unauthorized activity while the legal clock is still working in your favor. To be fair, the same monitoring systems described in Rule 2 that occasionally flag legitimate transactions from seniors are the very systems that catch real fraud before an account gets drained. The frustration comes from the false positives, not from the existence of the system itself. It is also important to understand what your bank is and isn't required to do if you ever become the target of actual exploitation rather than a false alarm. Under the Senior Safe Act passed in 2018, bank employees who receive specialized training in recognizing signs of elder financial exploitation receive legal immunity for reporting suspected abuse to the appropriate authorities, even without your explicit permission in that moment. Some states go even further, requiring banks to delay suspicious transactions for a specific number of business days to allow time for an investigation, rather than simply flagging it after the money is gone. That delay can certainly be frustrating if your transaction is legitimate, but it exists because in cases where fraud is actually happening, that temporary window is often the only thing stopping the money from leaving permanently. Knowing this distinction matters, because a delay isn't always caused by the trusted contact rule or the monitoring rule alone. Sometimes it's a state-level hold doing exactly what it was designed to do. Here is your 5-step action checklist for this week. First, confirm your trusted contact designation. Call your bank or log into your online account to see if one is currently on file. If not, request the form and name someone who truly understands your financial situation and knows they've been listed. If a contact is already listed, verify that it's still the right person and that they understand what the bank can and cannot share with them. Second, review your last 90 days of transactions for anything that might look unusual under automated monitoring rules, such as large withdrawals, deposits from new sources, or several transfers in a tight window. For any legitimate transaction that could look strange out of context, gather your documentation now before the bank asks, and keep it in a folder you can access quickly. Third, verify your account terms directly. Ask your bank what your current monthly maintenance fee is and exactly how to have it waived. Ask what the current overdraft protection fee is and compare both numbers to what you were paying 2 years ago. Fourth, ask specifically about senior account products. If new fees have appeared on your account, ask whether your institution offers a senior checking account with no monthly fee using those exact words. Give your bank the opportunity to move you into a better option. Fifth, document any large transaction before you make it. If you plan to move more than $5,000 from any source, whether a property sale, a family gift, an inheritance, or a consolidation from another bank, write a short summary detailing the source, the amount, and your contact information, and hand it to the teller at the time of the transaction. That single step turns a lengthy compliance review into a quick confirmation. And above all, do not structure your transactions ever. The instinct to break a large deposit into smaller pieces to avoid drawing attention might feel like common sense, but it is a federal offense. If the money is legal, deposit it all in one transaction with your paperwork ready. A currency transaction report on a clean deposit costs you absolutely nothing, whereas a structuring investigation can cost you your time, your peace of mind, and your money while you attempt to prove you did nothing wrong. You now know all 3 rules, why they exist, and exactly what steps to take regarding each one this week. None of this requires hiring a lawyer, paying a fee-based advisor, or booking a special appointment reserved for wealthy clients. Every single action listed above involves a simple phone call, a basic form, or gathering a folder of documents you already have. Best of all, you can start every single one of them today before your next statement cycle closes.